Land and building. These are separate assets and are separately accounted. Land and building has to be separately accounted. Why? We know that the land has usually infinite life and the buildings are usually finite life. So when the life of the asset is finite, it has to be depreciated, right? So building is a depreciable asset and land is a non-depreciable asset. So this land and building has to be separately accounted. If we should not club the land and building into a single asset and depreciate entire land and building. We can't do that. We should not depreciate the land. We have to separately account for both these land and building. Now let's learn about depreciation. There are different methods of depreciation like straight line method, written down value method, or units of production. Based on the production number of units produced, we can use depreciation. Straight line method, what's the formula for depreciation? Cost minus residual value by life. It will useful life, right? So it will be same for every year. And in written down value method, we use a certain rate for depreciation. Now when will we start to provide for depreciation? The start date is when the asset is available for use. When the asset become available for use, we should start to provide for depreciation. On 1st January, we have constructed the asset, and from 1st May, asset becomes available for use, and on 1st October, it is started using the asset. Even if it is available on 1st May, it is started to use on 1st October. Now, when will we start providing for depreciation? We will provide for depreciation when the asset is available to use, that is on 1st May. And when we stop providing for depreciation, when the life is over or the asset is sold, we have to stop providing for depreciation. When the carrying value of the asset reaches the residual value, then there is no depreciation. So that's about the start date and end date for providing depreciation. Next topic is component accounting, major replacement of components or major inspection and overhaul. So we are talking about component accounting. Each significant part of the PP having different useful life should be depreciated separately. So there are some significant parts and each significant part have different useful life. We have to depreciate it separately itself. We have to apply component accounting. Each significant part of the PP have different useful life should be depreciated separately. When significant component is replaced, new cost of the component is added and all the carrying value of the component is reduced. When a significant component is replaced, what we have to do? We have to add the new cost of the component and subtract the old carrying value of the component. Carrying value of old component. Now, let's see. Changes in the estimate of depreciation method, useful life or residual value. So when we are checking about there is a change, the company has changed the depreciation method, or there is a change in useful life, or there is a change in residual value, what we will do? That is considered as a change in accounting estimate as per AS5. So we have seen in AS5 that when the depreciation method is changed from written down value to straight line method, or when the useful life of the asset is changed as on revision, we will consider it as a change in the accounting estimate as per AS5. This is actually discussed in AS5 lecture. Now the next topic is insurance claim. So when the insurance claim is received, what we will do? Income as we will recognize it as an income in the P&L in the year in which the claim is certain to be received. The insurance claim, we will recognize it only when it is certain to be received. When it is recognized as an income in the P&L in the year in which the claim is certain to be received. And loss on damage or income should be shown separately and it should not be netted off. The loss on damage or any income we have to show separately. We should not net off it. Now what about spare parts, tools and servicing equipments? If these spare parts, tools and servicing equipment meet the definition of PPA, we will account it on basis of AS10. We will apply AS10 if it meets the definition of PPA. If it doesn't meet the definition of PP, then we will account it on the basis of AS2. AS2, valuation of inventory, we have already learned it. So spare parts, tools and service equipment, if it meets the definition of PP, then AS10 will apply. If it doesn't meet the definition of PP, then AS2 will be applied. Now what about derecognition of PP? We have to derecognize the PP when the asset is sold or the life of the asset is over, right? So there might be any gain or loss. What we have to do, we have to transfer it to the P&L, and if there is any remaining balance of revaluation reserve, it has to be transferred to retained earnings. That's about derecognition of PP. We have to transfer it to the P&L, and if there is any balance in revaluation reserve, we will transfer it to retained earnings. Now what if there is a change in the existing decommissioning, dismantling and site restoration? So we have already seen that while finding out the cost of the inventory, we will add it, the decommissioning, dismantling and restoration cost, to the value of the asset. We will add it, right? So after many years, we found that there is a change in the decommissioning, dismantling and restoration cost. What will we do then when there is a change? This change may result from change in timing or the amount. The change can be due to many reasons. So suppose the change occurs, what we have to do? The asset is measured using cost model. If the asset has to be measured using cost model, we will adjust the change from cost of the asset. If there is a change in the dismantling, decommissioning cost, and if the asset has been measured using cost model, we will adjust the change from the cost of the asset. Suppose there is a PP account debit to decommissioning provision. If there is a gain, if it is an increase in the cost, if the decommissioning, dismantling, site restoration cost has increased than previously, the price of the asset has to increase, right? So asset account debit to decommissioning provision. And if it has reduced, then decommissioning provision account debit to PP account. Now, if the asset measured using revaluation model, we have measured the asset using revaluation model, we have to adjust the change from revaluation gain or loss. We will adjust it using the P&L account, revaluation gain or loss account using the P&L. So, if it is a loss, revaluation loss account debit to decommissioning provision, and decommissioning provision account debit to revaluation gain. So this is how we will treat if there is a change in the decommissioning, dismantling and site restoration. If the asset is measured using cost model, we will adjust it from the cost of asset, and if it is measured using revaluation model, we will adjust from revaluation gain or loss accordingly.